Michael. Let me pause on my kind of line of questioning, see if there's any questions. Anything is fair game, folks. Whatever you want to ask or whatever you want to know. All right. Well, let's keep going. Let's shift gears, kind of the legal side. Robert, if you wouldn't mind laying out how loan sales differ from a typical buy-sell, that'd be useful.
Well, I think I had written that out as a question, and the answer is they really don't differ that much in terms of what you're looking to draft vis-a-vis, buy, sell a real estate piece of property. I mean, you're still going to have your same issues you have to deal with. How much representations does the seller want to make, and how many representation does the buyer want? It's always a tug match as to what the buyer would like in terms of reps and warranties from the bank with respect to the credit that they're purchasing. My view tends to be that, bank wants this off their books. You're buying it as is with all its warts. We don't really want to make many representations and warranties unless the bank is feeling really stressed about the credit. You'll take it as is. This is what's outstanding on the loan, and, take it or leave it. What I've seen recently is that most of the loans that I've dealt with are real estate backed, and there hasn't been much that I see movement in valuation. So the banks are pretty much looking to get out what they've got in. They're not really giving much price breaks because they see a loan to value with the loan. So there really isn't much give on the pricing. So that's what I see, and that's with respect to loan sales, that's what I see going on. Just to go back over, a lot of these credits that wind up selling are really credits that were troubled to begin with. And, a lot of them come through foreclosure, which I happen to do a lot of commercial foreclosures. And in New York, it's kind of unclear as to what the courts are doing vis-a-vis foreclosures. With respect to residentials, there's pretty much been a hard stop on those. But commercial foreclosures, you can move, not easily, but you do need to get the court on board with you. You have to set up what they call a COVID conference, which the courts are now reaching out to attorneys like myself, and they're setting up these conferences just to find out what's the status with respect to this credit. Why are we here? Is the debtor's default based on COVID? If it is, the court I think has within its discretion to really stay that action. I haven't come across any instance in the commercial vein where the court has stayed the action. But again, it's a case-by-case basis. Again, I think we can move commercial foreclosures, and like I said, I'm seeing that a movement taking place now. So I don't know if anybody has any other questions.
Thank you, Robert. I think there's a couple of questions actually that have come in on the chat. Maybe we'll hit those real quick. Bert asked the following: any significant difference in the loan sale market when sourcing from regulated versus non-regulated lenders?
Well, I deal mostly with institutional clients who are regulated, so I don't really get any private sales per se. So I really can't speak to that. But I don't see how any of the regulated institutions, I don't see any difference, in negotiating a deal with a regulated institution. It's just, however the deal breaks, it breaks.
Yeah, and I can speak on our behalf. I mean, we do portfolio sales, whether it's real estate or consumer or otherwise, typically from unregulated lenders, quote unquote. And really, it's the deal that takes the day. Whatever deal you can cut, you obviously want very strong counsel and accounting teams behind you. But it's the deal, and if it's a fair deal on both sides, it tends to get done. So really no impediments. If anybody else wants to comment on that, regulated.
Yeah, I would note that some of the non-regulated sellers, because they don't have to achieve true sale from an accounting standpoint, they'll oftentimes finance purchases off of their own book with seller financing. So, either selling or keeping a participated stake in a loan, they try to get a little creative to get a little more juice out of pricing, which many regulated lenders can't do. Or if they do it, they have to write it as a truly new loan, as a facility to the borrower, and clean their balance sheet and then do take back financing essentially. So it's a different gambit, but runs into accounting and probably some legal issues.
We've actually done that, Michael, on our end with Robert's assistance for the first time. I was mentioning we had a multifamily in the Bronx, like a $20 million deal where we provided financing for the purchaser.
Yeah, the note-on-note financing, it is underwritten as a new facility.
Yep. Yeah, it's tough getting true sale on it, but if you can, it's a great way to keep an interest earning asset in your balance sheet, get exposure to a new borrower, and by the way, mitigate your losses. So why not?
Yeah.
Thank you. John Luke, I think you have a question. Feel free to chime in.
I was just curious on how the sensitivity analysis is out there. What happens if this COVID pandemic doesn't reach herd immunity until spring of 2022? So, just how sensitive are we to disruptions in the plans that you guys have?
Who would like to tackle that from their vantage point?
I would say from a buy side standpoint, the market right now the sentiment is incredibly favorable and positive as it relates to a vaccine. Most seem to be underwriting a recovery in the next 6 to 12 months from, as regulations loosen around lockdown measures and whatnot, and as the vaccine rolls out and herd immunity is achieved. The downside you speak to is a reality. I mean, there's articles out there from brilliant scientists talking about how we could be living with this indefinitely, if not many years. But I think there's general optimism. You see it across beyond our small sliver of the universe. You see it in the stock market right now, where companies are releasing earnings that are disappointing, and their stocks are rallying. So I think sentiment is disconnected from reality to some extent. If that shifts, obviously the market will retrench in time, but for now we're underwriting a strong recovery. Okay,
thank you for that. Keep the questions coming in. Maybe back to Brett. Can you comment on the regulatory environment as it relates to loan sales?
Sure. So regarding the regulatory environment, a lot of that more has to do with bank and regulated type industries. We buy from non-regulated, like merchant cash advance companies, which are totally unregulated industry, and it's more of an issue internally. From the buy side, we had an earlier question that was addressed as well. It really isn't from the buy side. The only things that we have to do is accommodate whatever needs there are from the seller, whether we need to become an approved vendor, even though traditionally we're not a vendor for a bank, but they want you to dot all those I's and cross all those T's. We haven't seen much of it affecting us or affecting the sale. It's really more of the seller trying to figure out ways to make everyone happy within and getting through the red tape to make the deal done. Some of the regulatory with the CFPB, which is consumer related, is starting to or many years ago, I guess it was back when Obama was in office and it looked like Hillary Clinton was going to be the next president. A lot of the CFPB was looking to trickle in and go over the line and dipping their toes into the commercial side and adding regulations there. Due to the fact that we had a different president, that hasn't been an issue. And with everything that's been going on, it seems to have been swept under the rug for a while, but it could definitely resurface with the new Democratic presidency.
Thank you, Brett. Any other questions Okay, Joseph, back to you. Why don't we just step back for a minute and talk about why banks do in fact do note sales, and then maybe talk about insulating yourself from liabilities as it relates foreclosures and so on, if you wouldn't mind a little color on that.
Sure. So, obviously the banks that are experiencing a heavy amount of non-performing loans on their books need to allocate loan loss reserve against them. So a note sale will provide a quick and cost-effective manner in order to eliminate those non-performing assets and reallocate the proceeds going forward with new business. It also, the second part of that, as far as protecting the banks, as Robert mentioned earlier as well, we try and when we do sell our notes, we will basically, as is, where is, without really many reps or warranties as possible. And as well as if we do have we start a foreclosure action prior to the note sale, and we start to shop the note around, we try and get a rent receiver appointed on any income producing properties as further insulation for the bank to protect it from any liability.
Thank you, Joseph.
Yeah, I would just say that, just to piggyback off of what Joe said, I mean, in New York, there is a problem, as I think many of you know, with respect to rents and receiving rents in today, with what's going on right now. I don't know that there's a huge backlog, and you hear numbers being thrown around of outstanding rent, and the question is is that ever going to be collectible, and how's that going to affect the market in the long run? It's going to have some effect, and when that takes place, who knows? While properties do have a rent roll, whether or not it's collectible, in the city here in New York is somewhat questionable right now.
Thank you, Robert. Marianne, I know we have about 2 minutes left. Do you want me to continue onward, or do you want to open? How would you like to proceed?
Yeah, I think we can, if you have some closing statement, I think that people usually have a tendency to wrap up and have something else going on, so we tend to not.
I mean, I'll certainly I'll ask one more question of the group that I'm just personally curious about. In this 0/negative rate environment, how are people thinking about yield, and where are you achieving yield, right? That's one of the great questions. For us specifically, our client base is usually, depending on who the client is, we're finding yields for insurance companies in the low single digits that are long dated from our clients that they're happy with. And we go all the way up to 12% for other investors, typically the credit funds and so on. But how are people thinking about yield these days, and where are they finding it? Just out of curiosity.
I'll throw out a statement that was made by a buy-sider at the tail end of last year, a little scary. We've thrown our yield-driven model out the window. We're looking at things from a basis standpoint. We need to put money to work.
I think Ray Dalio echoed that sentiment as well last year. Okay. Well, thank you, everyone. We really appreciate your time. Hopefully this was helpful to everyone. And I know, Marianne, thank you again for setting this up, and we would encourage everybody to follow up next week with one another. Thank you.